Imagine you're in a jungle, a financial jungle filled with stocks. How do you know which one to pick? Stick around to learn how to navigate this wild terrain. Welcome to the wilderness of the financial world, where stocks grow like towering trees and opportunities hide behind every leaf. Just as in the heart of the Amazon, thriving in this stock market jungle demands knowledge, skill, and a touch of daring. Now you might be wondering, why is understanding this jungle so important? Well, in the 21st century, the financial landscape has become as integral to our lives as any physical environment. Whether you're an eager investor or just someone trying to understand the financial headlines, knowing how to pick the right stock can be the difference between survival and getting lost in the undergrowth. So, are you ready to embark on this journey of discovery? To learn the language of the jungle and uncover the secrets of the stock market? Ready to become a stock market explorer? Buckle up. Before we dive in, let's understand the basics. What is a stock and why should you care? Well, in the simplest terms, a stock represents a tiny slice of ownership in a company. Imagine a giant pizza divided into millions of pieces. When you buy a stock, you're essentially getting one of those pizza slices. Except instead of pepperoni and cheese, you're getting a part of a company's assets and earnings. So, why should you care about owning this metaphorical pizza slice? Well, there are a couple of reasons. First off, as a stockholder, you get to have a say in the company's affairs. You're not just a customer anymore. You're part owner. You can vote on company matters, like who's going to sit on the board of directors. The second reason is the potential for financial gain. If the company does well, the value of your stock goes up. Think of it this way, the tastier the pizza, the more people want a slice, and the more they're willing to pay for it. But hold your horses, it's not all roses and rainbows. The stock market can be a volatile place. If the company's performance dips, the value of your stock can go down. So, it's like if the pizza suddenly starts tasting bad, people won't want to pay as much for it. And finally, there's the concept of dividends. Some companies, especially the well-established ones, will share a part of their profits with their stockholders. This is like getting a little extra cheese on your pizza slice every now and then. But remember, not all companies give out dividends. Some prefer to reinvest their profits back into the business. So, it's something to consider when you're choosing which stocks to buy. So, you've got the basics down, now it's time to go hunting. First stop in our jungle expedition, the company itself. Imagine you're an explorer, venturing into the wilds of the stock market. Your compass? The company's performance. Your map? Its stability. Your prize? Its growth potential. The importance of researching the company cannot be overstated. Think of it as getting to know your hiking partner before embarking on a treacherous trek. You wouldn't want to blindly trust someone to have your back on a cliff edge without knowing their capabilities, now would you? Likewise, before investing in a company's stock, you should dive deep into its financial health. Look at their balance sheet, income statement, and cash flow statement. These documents hold the secrets to the company's financial strength. They tell you whether the company is making money, how much debt it has, and if it can keep its operations running smoothly. But don't stop there. Take a look at the company's history. Has it been consistently profitable over the years? Does it have a habit of weathering economic downturns? If it's been able to stay afloat during tough times, it's a good indication that it's a sturdy ship capable of navigating the stormy seas of the market. Next, consider the company's growth potential. Is it a small fish in a big pond with room to grow? Or is it a big fish in a small pond with limited opportunities for expansion? Remember, growth potential is a key factor in determining a stock's future value. And let's not forget about the company's management. After all, a ship is only as good as its captain. Research the company's leadership. Are they experienced? Do they have a track record of making good decisions? A strong leadership team can steer a company towards success, even in choppy waters. Remember, a solid company is the foundation of a solid stock. So make sure to do your homework, because when it comes to investing, knowledge is your best tool for survival in the stock market jungle. Scene script. Next, we venture into the broader ecosystem, the industry. To find the right stock, you need to understand the industry in which the company operates. It's like learning the rules of the game before you play. No matter how promising a company may seem, if its industry is on a downward spiral, the company might struggle to thrive. So, how do we get a grip on the industry trends? Consider a surfer riding the waves. Just like the surfer, you need to catch the right wave, the industry trend, at the right time. If you paddle too early, you'll get wiped out. Paddle too late, and you miss the wave entirely. The trick is to understand the currents, the tides, and the timing. In the same vein, understanding industry trends involves keeping an eye on the market's ebb and flow. You need to monitor the demand and supply, technological advancements, regulatory changes, and shifts in consumer behavior. It's about seeing the big picture and spotting patterns. Take the electric vehicle industry for instance. It's currently experiencing a surge due to increasing environmental awareness, advancements in battery technology, and supportive government policies. If you had spotted this trend early, you could have ridden the wave to significant profits. But remember, it's not just about the industry trends. You also need to understand the competition. Is the company you're eyeing a big fish in a small pond or a small fish in a big pond? A company could have a great product, but if it's up against a Goliath, it may struggle to make a mark. Finally, pay attention to market conditions. Is the economy booming or in a slump? Is there political instability that could affect the industry? The broader economic and political climate can significantly impact an industry's prospects. In summary, to find the right stock, you need to look beyond the company itself and understand the industry it operates in. You need to be aware of the trends, the competition, and the market conditions. Keep an eye on the industry, and you'll be one step ahead of the game. Now, we dive into the numbers. Welcome to the world of financial ratios. Imagine yourself as a detective, ready to uncover the financial health of a company. You're not looking for a magnifying glass or fingerprints though. Instead, you're armed with financial ratios, sharp tools that slice through the numbers and reveal the truth behind them. First up, we have the price-to-earnings or PE ratio. This handy ratio tells us how much an investor is willing to pay for each dollar of a company's earnings. Think of it as the price tag on a company's profits. A high PE ratio could indicate that the market has high expectations for a company's future growth, but it could also suggest that the stock is overvalued. Conversely, a low PE ratio might mean the stock is undervalued, or that the market has lower expectations for its future growth. Next, we have the return on equity or ROE. It's a measure of how efficiently a company uses its shareholders' equity to generate profits. A high ROE often indicates a company that's good at turning equity into earnings, which is a very good thing if you're an investor. Then, there's the debt-to-equity or DE ratio. This one is all about balance. It tells us how much debt a company has compared to its equity. A high DE ratio might indicate that a company is heavily financed by debt, which can be risky. On the other hand, a low DE ratio might suggest a company is more conservatively financed, but could also mean it's not taking full advantage of the leverage debt can provide. Remember, these ratios are not standalone indicators. They are pieces of a larger puzzle. They need to be used in conjunction with other information to paint a complete picture of a company's financial health. Armed with these ratios, you're now a financial detective. Think you found the one? Hold on. Ever heard of don't put all your eggs in one basket? Well, that old chestnut holds a lot of truth when it comes to investing in stocks. You see, diversification is essentially your financial safety net. It's like having multiple parachutes instead of just one when you're skydiving. Let's say you found a stock that you're absolutely smitten with. It's been doing well and you're convinced it's the golden goose. But what if that goose gets the flu? If all your money is tied up in that one stock, you're going to take a nasty fall. But if you've spread your investments across a range of stocks, a hiccup in one won't send you spiraling. Imagine you're at a buffet. You wouldn't fill your plate with just one dish, would you? No, you'd sample a bit of everything. That's exactly what diversification is all about. Now, diversification isn't just about investing in different companies, it's also about spreading your investments across different industries. If one industry takes a hit, others might be doing just fine. So, you're cushioning your financial health against market volatility. While diversification can help you mitigate risk, remember it doesn't guarantee profits. There's always a level of risk involved in investing, but with a diversified portfolio, the highs and lows of different stocks can balance each other out, making your financial journey a bit smoother. To put it in simple terms, diversification is about playing the field. It's about not getting too attached to a single stock or industry. It's about spreading your money around like butter on toast to ensure you're covered no matter what. So the next time you find a stock that makes your heart flutter, remember to keep your feet on the ground. Don't pour all your money into it. Spread your investments and remember the stock market is a long game. You're not just in it for a quick fling. Diversify and you'll weather any storm. Now you've made your picks, but the game isn't over yet. You've analyzed the companies, taken note of industry trends, and calculated your financial ratios. You've diversified your portfolio. You're feeling ready, excited, maybe a little nervous. And now, you're waiting. It's a bit like planting a seed and waiting for it to grow. You can't rush it. You can't dig it up to see if it's sprouting. You just have to trust in the process and have patience. But let's be clear, patience isn't about sitting idly by or ignoring your investments. It's about understanding that the stock market is a long-term game. It's about resisting the temptation to react to every blip on the radar, every headline that screams doom or promises instant riches. It's about not letting fear or greed dictate your decisions. Think of the stock market as a roller coaster. It has its ups and downs, its thrilling highs and scary lows. But if you've done your homework, if you've chosen solid, reliable stocks, you know that over time, the trajectory is likely to be upward. So strap in for the ride. And remember, it's not about getting to the destination as quickly as possible. It's about staying on the ride. And here's a little secret. Time in the market beats timing the market. That's right. History has shown that the most successful investors are not those who tried to predict the perfect moment to buy and sell, but those who stayed, invested over the long haul, through the good times and the bad, through the booms and the crashes. So, as you navigate this stock market jungle, equip yourself with patience. Nurture your investments like you would a garden. Give them time to grow and flourish. Be steadfast in your strategy, resilient in the face of volatility, and always, always patient. Remember, in this jungle, patience isn't just a virtue, it's a survival skill. Congratulations, you've navigated the stock market jungle. As we bring this adventure to a close, let's take a moment to recap the key points we've covered. First, we ventured into the stock market basics, where we learned that investing is not just about buying low and selling high, it's about understanding the company, its industry, and how it performs financially. Remember, knowledge is power. And in the stock market, it's also wealth. We then embarked on a journey of analyzing the company. We discovered that a company's financial health, growth potential, and competitive advantage are crucial factors to consider. It's like choosing a companion for a long journey. You want someone reliable, strong, and capable of weathering storms. Next, we dived into the world of industry trends. Much like a surfer riding a wave, investors need to be aware of industry trends and changes. Riding the right wave can lead to significant gains, while missing the wave can lead to missed opportunities. Our adventure continued into the realm of financial ratios. These are the compass that guides us through the financial wilderness. By understanding ratios like the price-to-earnings ratio, debt-to-equity ratio, and return on equity, we can make informed decisions about the value and potential of a stock. We then explored the importance of diversification. Just as you wouldn't put all your eggs in one basket, you shouldn't put all your money in one stock or sector. Diversification helps spread the risk and can lead to more stable returns. And finally, we learned the value of patience. The stock market is not a get-rich-quick scheme. It's a long-term investment strategy that requires patience, discipline, and a steady hand. Now that you're equipped with these tools, you're ready to conquer the stock market. Don't forget to subscribe to our channel for more financial wisdom. Happy investing!